Let's dive right in. Today, January 28th, 2026, the market did something that, on the surface, looks completely impossible. We saw an absolutely massive rally right in the face of a huge threat. So we're going to break down exactly how that happened and, more importantly, what it could mean for all of us. Okay, so here is the big puzzle we need to solve today. South Korea's main stock index, the KOSPI, just smashed through the 5,100 level for the first time in history. But at the very same time, the US is threatening a devastating 100% tariff on the exact thing driving this whole rally, high-end memory chips. It just doesn't add up. So how on earth is this possible? To figure this out, we're not just guessing. We're going straight to the source. We've got our hands on the Global Financial Synthesis 2026 report, and we're going to use it as our guide. It's packed with the data and the models we need to really decode what's going on behind the scenes. And the numbers, wow. Just look at these closing figures for today. The KOSPI is up almost 1.7%, hitting that all-time high. The tech-heavy cost you an unbelievable 4.7% surge. And you know, this wasn't just a Korea story. The Hang Seng in Hong Kong also jumped over 2.5%. These are not small moves, folks. This is a powerful, widespread rally across the region. So, what is the logic here? Is everyone just going crazy with irrational optimism? Or is there something much, much deeper happening? Well, the report argues it's definitely something deeper. And it all kicks off with a really powerful theory about what's happening in South Korea. So the first idea is called professional logic, from a philosopher named Günter Dück. The best way to think about it is like this. If you are the only one in the world who makes a critical part for a new airplane, it doesn't really matter what taxes or tariffs get thrown around. Airlines have to buy that part from you, period. Right now, that critical part is HBM4 memory. It's the lifeblood of AI, and South Korea is basically the world's only supplier. And this quote from the report just nails it. It says that even with a 100% tariff, the market is betting those costs will just get passed right along to the final consumer. And why? Because there are no substitutes. If you're building the next generation of AI, you have to have this memory. It's not optional. And investors are betting big on that reality. Okay, now for theory number 2. And this one comes from the legendary investor Ken Fisher. He calls it the rational bull. And this is fascinating. It's not a rally built on pure hype. It's what happens when stock prices are going up, but the actual profits of the companies are going up even faster. So strange as it sounds, the market can actually get cheaper and become a better deal, even while it's hitting record highs. And here is the proof right in the data. Just look at this chart. At the start of this bull run, the KOSP's price-to-earnings ratio, basically its price tag, was 11.7. Now look at today. Even after this huge surge past 5,100, that price tag has actually dropped to 10.6. It's cheaper now. This is a perfect example of a rational bull market. The earnings are just exploding, literally outrunning the stock prices. So that really explains the situation in Korea. But what about those big rallies we saw in China and Hong Kong? Well, the report says that while tech is definitely a factor, the main driver there is something else entirely. A big shift in the institutions themselves. For this, we have to look at the work of the 2024 Nobel Prize winner, Simon Johnson. His big idea is that real, lasting economic growth comes from what he calls inclusive institutions. Basically, it means having rules and systems that protect people's investments, encourage new ideas, and give companies the freedom to grow. The market is basically betting that China is making a serious move in this direction. And this isn't just a vague feeling. Investors are pointing to very specific signals. The report notes that China is front-loading pro-growth policies, but the really big ones are the changes in the market itself. They're letting huge companies like Baidu have dual listings and allowing them to spin off their most valuable parts, like the AI chipmaker Kunlun Core. Investors see these as huge, positive signs. All right, so we've got the why behind this incredible rally. We have the theories. Now this is where the Global Financial Synthesis report really shines. It takes all these powerful ideas and plugs them into its computer models to give us some actual data-driven forecasts about what could happen next. So for the KOSPI, the model is projecting a potential high-end target that would mean another 8.3% gain just for the month of February. What's driving that? Well, it's the expectation of those mind-blowing semiconductor profits being confirmed and some kind of trade resolution with the US.
Now, over in Hong Kong, for the Hang Seng Index, the potential upside is even bigger. The report's model is pointing to a high-end gain of 9.6%. This is largely based on the idea that the U.S. will cut interest rates later this year, which would send a flood of new money into Asian markets.
But the real showstopper, the one that makes you do a double take, is the projection for Baidu. Because of all the excitement around its Kunlun Core AI chip IPO, plus a really strong rating from a major bank, the model is spitting out a potential target with a staggering 25.6% upside just for February. Now, seeing numbers like that is really exciting, right? But it also brings up a really important question. In a market that's moving this fast, how would a professional actually navigate it? I want to be crystal clear. What follows is not financial advice. It's a case study from the report, a fascinating look into a type of data-driven quantitative strategy. The strategy has a cool name, the Four Corners Regime Filter. You can think of it like a weather forecast for the market. It uses technical data to define what the current weather or regime is. Is it a sunny bull market? Is it getting a little too hot and overheated? Is a storm brewing in a mild bear market? Or are we in a full-blown crisis hurricane? The data tells you which box you're in. And here is the really clever part. For each of those four market weather conditions, there's a preset action plan. No guessing, no emotion. The model says we're in a bull regime right now, so the plan is to be fully invested. But if the data says the market is overheated, the strategy automatically dials back the risk, shifting to half stocks, half gold. It's a system designed to enforce discipline no matter what's happening. And finally, maybe the most important piece of the puzzle, managing risk. The report calculates something called the one-day value at risk, or VAR. That number, 1.45%, is basically a safety net. It means that based on how the market is behaving right now, there's a 95% chance the portfolio won't lose more than that amount in a single day. It's all about knowing your downside before you even start dreaming about the upside. Which brings us to the big final question. After looking at all the theories, the numbers, and the strategies, what are we actually looking at here? Are we witnessing the start of a brand new, long-term bull market, one that's being driven by the unstoppable force of AI technology? Or is this just a beautiful, spectacular peak that's incredibly vulnerable to being knocked over by a single political decision? How we answer that question will likely define the markets for the rest of this year.